Good morning, everyone. How is everybody this morning? Thumbs up? Excellent. Well, good morning and welcome to the first Power Breakfast of 2024. I'm Susanna DeBaca. I'm the CEO of Business Publications Corporation, and I always look forward to our Power Breakfasts, which, as you know, go deep on topics of interest to the business community. Now, many of you may have noticed that our Power Breakfasts have sort of become Power Brunches. They used to be at 7:30, and how many of you like this time a little bit better than the super early? So nice job, team. So it's been a busy week. The legislature is in session, the Super Bowl happened, and yesterday was Valentine's Day. So I sincerely hope that Valentine's Day worked out well for you. But today we're going to turn to some more serious topics away from flowers and chocolates to interest rates and inflation. How great does that sound in comparison? As you well know, the last 24 months have been, I think probably most of the bankers and folks here would characterize it as interesting, in quotes, in the banking and finance sectors, as the Fed worked to manage the economy and to keep inflation in check. And at our recent economic forecast, which we had a couple of weeks ago, we looked very specifically at the overall economy, but today we're going to dive much deeper into the changing lending landscape. We have a great slate of expert panelists to guide our conversation today, and you'll hear from them, and we'll introduce them in a minute. But before we meet them and we dive into some really good, meaty conversation, I would like to introduce our Power Breakfast sponsors. Our first sponsor is Bankers Trust. They have been a long-time supporter of our community and a continued sponsor of the Power Breakfast series. Since 1917, Bankers Trust has been driven by an unwavering commitment to the success of customers and communities. Today, we're pleased to have Don Coffin, who is the president and CEO of Bankers Trust, as one of our panelists, since he is, of course, a top leader in the industry and an expert on this topic. But we will hear from him now on behalf of Bankers Trust, and then in a few minutes on the panel. So Don, welcome.
Thank you for that. If this was a year ago, I would have been shocked if anybody predicted what the last year held, at least from a banking industry standpoint. Silicon Valley Bank changed the game for us, and the industry faced 12 months of turmoil, I would say. We've been, it doesn't look like it, but I've been in banking for a lot of decades now. And through even a little bit of the farm crisis and the Great Recession, and it just feels like this was different. It seemed uncontrollable. It seems out of our hands in some ways. So there's a lot that went on this last year. I do want to thank the Business Record for putting this on. They do a great job. I want to thank the panelists, which sounds kind of weird because, all right, Snoop Dogg got an award. He was on the Walk of Fame. No one knows what I'm going to be talking about. But so in accepting the award, he got up and said, "I want to thank me," which felt like what I was just doing right there. So, but I want to thank me for believing in me. I mean, you got to look it up. It's great. He did a great job. I love that. But I really don't have any more comments to say other than thank you for being here. We appreciate being a part of this event. We appreciate being a sponsor of this event. And keep doing what you're doing. Thanks.
Thank you, Don. I don't know how many of you were at the Power Breakfast where he had riffed on the rock. I still remember that was a good one. We certainly appreciate your continued support of the Power Breakfast series. Our next sponsor is Forvis. They are a top accounting and consulting firm serving all 50 states. They are driven by a commitment to deliver an unmatched client experience. And joining us today from Forvis is managing partner Jeff Nag. Welcome, Jeff.
Good morning. It's great to be back. It's another year of the Power Breakfast series, and we're excited to be a part of it. My name is Jeff Nag. I am the managing partner for the Des Moines office of Forvis, and we're proud to be sponsors again this year. In the public accounting and consulting world, we've seen our clients, front and center with some of the challenges that we felt over the last couple of years that we've already heard about. Post-pandemic legislation, interest rate increases, inflation, and higher costs are all challenging. So with all these circumstances, it's a little bit unpredictable right now, as Don talked about. But I take great pride knowing it's a president election year. We all know in the financial world that in election years, historically, we can find market stability, lower economic tensions than we've seen in the past, predicting the economy going forward. I'm kidding, that's a joke. Seriously, we don't have the crystal ball, and if anybody does, I'd like to see it. But this panel up here is as close as we've got to a crystal ball, so we really appreciate them being here. That's a challenge, by the way. Excited to hear their thoughts and thankful that we can be a part of this. Thanks for filling the room. Really appreciate the business record, appreciate the panelists, and we're looking forward to the series. Thank you.
Our next sponsor is Lean Techniques. We are very excited to welcome them as a new sponsor to the Power Breakfast series. Whether it's digital transformation, IT modernization, or software delivery, Lean Techniques helps their clients create solutions to help run businesses. And we'd like to welcome Danielle Brummer, who is the Chief Growth Officer. Danielle?
Thank you, Susanna. Good morning, all. I'm happy to be here on behalf of Lean Techniques. We are thrilled to be sponsors this year of the Power Breakfast series. This is our first time to be a sponsor. The business record has really been doing all the hard work and bringing us all here this morning and bringing the community at large together to discuss the most important topics impacting our businesses and our workforce. And of course, today's topic is no different. Lean Techniques is a technology and management consultancy. We work with a variety of clients across financial services, manufacturing, agriculture, and beyond. And what is true across all of these industries is that change is constant, and customers are expecting more than ever, and organizations need to be able to respond. As we've all discussed here this morning, it's been an unprecedented time for the past approximately 4 years. We've all been feeling it, and we believe it's here to stay. Today, our conversations with organizations are around how to become more agile, how to quickly adapt to the changing market, and how to ultimately leverage uncertainty. Whether that's because of a global pandemic, geopolitical concerns, a dynamic financial market, you name it, whatever the uncertainty is, we have to be able to leverage it as fuel to drive innovation. And that's the type of organization we help our clients evolve into. We believe we need to create a digital organization that is built for impact, where being able to adapt swiftly and innovate become your biggest strategic advantages. If you're curious to learn more about how we help our organizations today, please find me after the program or check out our website. We'd love to chat further. And finally, I just want to say thank you to all of the leaders here that are willing to share your insights and outlook on the current lending environment and what that means to our businesses and the executives here today. We are all better when we come together and learn from each other. So thank you all. Have a great rest of your day.
So a big thank you to all of our sponsors and of course to you again for being here this morning. And now I would like to introduce today's moderators, Senior Staff Writer Michael Crum and Associate Editor Mike Mendenhall. And you guys are already up here. Mike, come up. Michael, come on up. So let's turn it over to them and get started. Thank you. Round of applause.
Well, thank you, Susanna, and good morning to you all. Thank you for being here today and joining us for this conversation. As Susanna said, I'm a senior writer with a business record. I've been with the publication for almost 4 years now. After spending some time as editor of the Ames Tribune and as a reporter with the Associated Press here in Des Moines. Thanks to Vince for remembering me from way back when. I appreciate that. I also have to send a shout out to Don and Jeff for providing some comedic relief this morning, because that takes the pressure off of me and Mike to be funny. And for people who know me, I do not like having to be funny. My primary areas of focus have been on the broad issue of economic development, but I'm currently in the process of transitioning into helping cover and helping add to our commercial real estate coverage. And I'm filling the role of Chris Koneski today. So I'm not only asking for, I'm begging for some grace as I deal with an in-person event. I've moderated several virtual events, but this is my first time looking at you all face-to-face. I'm usually used to seeing you all as little thumbnails on my computer, so this is a different environment. So like I said, I'm looking forward to today's conversation and like all of you, learning more about what is in store for the banking and lending sector in the year to come. We have a great group of folks on the panel today to help answer those questions. So let's go ahead and get started. On our panel today, we've already introduced Don Coffin, the president and CEO of Bankers Trust. We have Vince Lintz, Executive Director of Economy Financial Development Corp. John Sorensen, the President and CEO of Iowa Bankers Association. And immediately to my right, Murray Williams, the President and CEO of the Iowa Credit Union League. Joining me on stage at the far end is Mike Mendenhall. He's the Associate Editor of the Business Record. He'll be taking the lead in asking the questions, maybe answering some questions as well. He joined the Business Record in October after nearly 5 years at the Jacksonville Daily Record in Jacksonville, Florida, where he covered city and state government policy and its effects on business. He's a Des Moines Eastside native and spent... No applause for the East Side, I'm sorry. Yeah. And he spent nearly 8 years at the Newton Daily News in various roles, including editor-in-chief, and his current focus with the Business Record is economic development, government, and law. So let's not waste any more time in jumping into the conversation. Mike, take it away.
Thank you, Michael. And good morning, everyone. Thanks again for all of you for being here with us today. When we asked our banking and lending leaders prior to today's event what development will define 2024 for their industries, there was one dominant theme, and that was interest rates. So what can we expect this year? Our panel of industry experts watch the lending market closely and are working with financial institutions, their commercial borrowers, their customers and entrepreneurs on the ground to help businesses navigate an uncertain monetary environment. Today, interest rates remain high, but appear to have stabilized. The Federal Reserve is sending signals that it might be ready to start lowering the benchmark rate after 2 years of hikes in their effort to cool the U.S. economy. This policy, it affects the price of goods, services, the ability for credit, of first-time entrepreneurs, the ability of those entrepreneurs to access credit, banks' ability to lend, and developers' capacity to build commercial projects and housing. So the intent is, after the next hour, is for you all to use what you've learned here today to navigate your businesses through their capital and monetary needs for the coming year. So let's go ahead and let's dive right in. So the first question today, just going to start with Dawn and move our way down the line. What will be the most important development in this year's banking and lending, that businesses large and small, startup and legacy should be thinking about when considering operating and growth strategies? So Dawn, go ahead and take us.
Well, ignoring the interest rates for a minute, I think the most important thing is just the way that we went through this and didn't have the recession that was predicted. And so far, it's been a fairly soft landing. I think the industry still faces headwinds with repricing of some of the commercial real estate and what's that going to do to those costs, but they have time to build in that and work with the clients and change the rents or whatever to move forward. I think business is still strong in general. I think there has been layoffs in some of the tech sectors of the business, but in general, I think business is still strong. I think the consumers are still confident, and inflation's still out there, but it's certainly not forgotten. But it's dropped considerably, and we're on a pretty good path. Projects. Some of the developers might have slowed down some of their projects, but good projects are still getting done. It might take more capital with the interest rates the way they are. It might take the prices to adjust to where the costs have gone. So some of their costs have gone up tremendously. But I think in general, the attitude is positive. I think in general, we're gonna get through this. So, yeah, I'll quit there.
All right. Vince, to you, same question.
Thanks, Mike. I work for a nonprofit agency that supports minority small businesses. A lot of them are startups. I think that I do believe, I don't have a crystal ball and I don't know why I'm up on this stage talking about interest rates, but the one thing that I'd like to point out, though, I do think that the feds will probably lower the interest rate. I'm hoping that they will. But the clients that I work with already are accustomed to higher interest rates due to the fact that they don't look like the traditional borrowers. A lot of them have credit history issues or are just getting into the business arena. So their interest rates when they go to the financial institutions are a little bit higher because of the risk involved. Plus, they don't have the background or the history, I guess I should say, for the businesses a lot of them are running. So I think that the big thing that will help my clients is a lower interest rate and then trying to figure out how to deal with the additional cost of supplies, materials, and the cost of doing business.
All right, John.
All right, thank you very much. Good to be here. Thank you, Vince, for all you do. And to, I think, Don and Vince's points, a lot of our customers are still suffering from interest rate shock, right? I mean, you talk about a rapid increase in interest rates, not only impacts our member institutions, in my case, the banks. By the way, it's really fun to be next to Murray here. Not many people would take that opportunity to put banks and credit unions on the same stage, but believe it or not, we do get along just fine. And at the end of the day, we're here to serve Iowans. It's what we do. We may have a little different approach, but we're actually here to serve Iowans. So I mean, I think our customers, as I think about the farmers and the small business people and consumers that we serve, homeowners in rural Iowa are still adapting to those rates. Credit is still available. Certainly margins have tightened at our member banks. Deposit competition is high, again, following the significant rate increase. And, we have to remember, we had a huge influx of pandemic dollars flowing into our financial institutions. At one time, we were flush with deposits and liquidity, had to find a way to deploy that. And in many cases, that was a difficult situation for our financial institutions. Do you go longer term to try and gain a little more yield on those investments? And by investments, I mean your bond portfolio and or the loans. But it did over that period of time created a very challenging environment, and I think we're seeing that a little bit today. Our margins, as I mentioned, are tighter than normal. Having said that, we have wholesale sources of funding beyond just our core deposits that we get from our communities that allow us to do more. And the other point I'd like to make is I think Iowa's so unique. I mean, I travel, I've been around this business for a while. I know I don't look like it, but I've been around for a while. And I travel the country and I talk to a number of other state banking association leaders, and they're in states that might have 50 banks. And most of it is dominated by larger institutions. Nothing wrong with that. We need a diverse financial industry to serve every need that our business customers have. But we in Iowa, we have 275 member financial institutions at the Iowa Bankers Association in almost every community, 1,500 locations in every community. So that makes a huge difference. And I think some of the data that we know of is reflective of that. We have one of the lowest percent of unbanked population in the country, 3%, based on an FDIC study. Iowa State University did a study recently that indicated if you are in a community that has a bank on the corner, the people are more financially literate. There's a demonstrated study that people are more financially literate because you have that relationship. You have local investment in your community, the bank sponsoring the Little League team, they're on the Economic Development Council, so on and so forth. So I guess my point, a little bit of a commercial here, but I think Iowans are so very well served because of the competitive environment we have here. And with that, I'll turn it over to Murray.
Well, good morning, everyone. Thank you for those kind words, John. As Vince said, if you're looking to, I'll only speak for myself, if you're looking to us to have a crystal ball for where the future is going, God help us all, because I don't know any more than the rest of you, but we'll give our insights here as we go. I don't know how many of you know what credit unions are and how we're different, so I thought I would just take one moment to mention that. But credit unions are a bit unique in the financial marketplace in the fact that we are member-owned cooperatives. So we offer the same types of services that banks do, but we're structured cooperatively. So you as a customer of a credit union, you're actually a member and an owner of that institution. And so as I think about the trends that are happening and what you all need to be thinking about from a business perspective, I really think through that lens, or what are the needs of consumers going in a savings standpoint. And we've all lived it. It's been a very volatile time. But I would say the first thing to consider is just consumer behavior and the uniqueness of what's going on right now. And we all have less spending power than we did. The cost of goods and services continues to go up, and it has been high here. Hopefully that's starting to come down again. We've also been borrowing less because of the high interest rate environment. But at the same time, a lot of us, people have not been necessarily reducing their spending. And so what they're doing is they're taking some of that savings cushion that they had through the stimulus and through the COVID time, and they're starting to spend that down. And so we're seeing historically low savings rates. And so that dynamic, that combination of factors, I think it's something that not only impacts financial institutions, but it certainly impacts all of us from a business perspective. A couple of other things to consider. One is this world of artificial intelligence. I don't know if anyone's heard about it lately with ChatGPT, but certainly in the financial services industry, this is a significant trend to be watching out for as well. Credit unions, banks, all financials need to be exploring and being innovative in that AI sector, but at the same time, there are a lot of unknowns, a lot of things that we all need to be cautious with, in particular with data privacy, data security. So I think that's one that we all just need to kind of tread slowly into. And finally, fraud. No surprise there, but fraud continues to be a bigger and more challenging issue, again, not only for financials, but for retailers, for all of us. The fraudsters and the cyber criminals continue to be more sophisticated, and so therefore we need to be as vigilant as well, increasing cost and infrastructure for cybersecurity. But from a credit union perspective, education is a huge component of what we do, financial education, and part of that is protecting yourself from a fraud standpoint as well. And so protecting our members, protecting all of your customers, making them more savvy consumers is an important thing in today's environment. And I think that's it.
All right. I think, Murray, we're going to stick with you here. And by the way, I'm really glad that the business record could bring both sides together, banks and credit unions on one stage with a pat on the back. It's good feeling, good feeling. So the U.S. benchmark interest rate is sitting at about 5.5%. Murray, I was going to ask you, how is the current rate affecting the overall mood of credit unions and lenders in Iowa? And then also too, afterwards we'll go over to John to talk about the mood of the banks.
Well, I'm assuming it's pretty similar, but we were talking to some of our credit union CEOs recently, and they said that this is one of the most challenging times that they've had to try to budget and forecast where the future is going. It's just been so volatile over the last couple of years, and so our job as credit unions is to lend, to provide support to our communities. And that's become more challenging here recently. And so I would say there is always optimism from a credit union perspective. We are, if you're not aware, we're largely focused on consumer lending. We also do a considerable amount of small business lending, but 80% of our portfolio in credit unions in Iowa is consumer loans. We only have 17% of the market share, but 30% of the mortgage loans originated in Iowa come from credit unions and 59% of the auto loans. And so we are a significant player in the consumer lending space. So when interest rates go up, when members are feeling a little more cautious about borrowing, that impacts us considerably. And again, this environment where people are starting to spend down their deposits as well makes liquidity a big challenge. And so I think there is cautious optimism, but it's been a challenging time for our leaders to forecast where things are going.
And John.
Yeah, Mike. Yeah, certainly I would echo what Murray said. Interesting times, margins, as I mentioned earlier, very much tighter than what we normally see in this environment. Somebody did an analysis or mentioned an analysis the other day. Think of a bank as a manufacturing company. They manufacture financial products and service. They package those, and then they distribute those products and services. Sometimes they work with fintechs, other companies to help distribute those products and services, but they're not unlike any of your businesses. You have a cost of goods. So our cost of goods is what we have to pay for funding, through core deposits or wholesale sources of deposits. Another cost we have is just the cost of operations. And I will tell you, the cost of operations has increased significantly over the last year. And much of that due to regulation, well-intended regulation. But what we have found in the financial services industry is, used to be that financial regulators were very independent, not necessarily appointed because they had any particular political persuasion. And I'm not saying one side or the other. I'm just saying political agendas have entered in the financial services world more than I've seen in my career. And what that means is we have an election coming up this year. A lot of our regulators are just giving us a tsunami of new regulations because they want those out by June 30. Because if they don't get them out by June 30, they could be subject to what's called Congress could come back and reverse those because of the CRA. I'm going to lose my terminology a bit, but anyway, they're subject to being reversed by the next Congress. And so those are the kind of things that cause us to have to not only deal with a very interesting economic and interest rate environment, but also try and implement thousands of pages. There were 5,000 pages of new regulation issued just in the last year alone. You think about a small community bank in Corwith, Iowa, my hometown, and how do you adapt to that? How many people can you afford to bring on board, if you can find them, to help you move that regulation through and make sure you're checking the boxes? Again, some of the regulation is well-intended. I'm not saying it isn't, but what that is forcing us to do is the industry will consolidate with that, and we'll lose the diversity, and we'll lose those hometown banks. And it's a concern that I think all business people in our state should be concerned about. I could give you very good examples of that, but something we all should be keeping an eye on.
All right, we'll get back to the politics and the regulations here in a minute. I did want to go to Vince and ask him a little bit about the overall mood of banks and credit unions and lenders from your client standpoint, and share some of the strategies that you use to kind of navigate that high interest rate environment when you're working with these new entrepreneurs, new startups, and how they can get access to capital.
A lot of our clients, for an example, I don't know if you're familiar with the One Economy report that came out in 2014, and then it was updated in 2017. Also, the Iowa Credit Union Foundation just came out with a report that is very informative too. I would suggest that you take a look at that. But a lot of our clientele, an example is 25% of the African Americans in Polk County are unbanked. That means they don't have a banking account or a relationship with a bank. 30% are underbanked. That means that they have savings or a checking account, but they still don't utilize the services of those lending institutions like they should. They could go to the local lender in a strip mall, basically at a higher rate. So it's the convenience more than it is the interest rate, unfortunately. But that goes back to the education, I think, aspect of it. That and an understanding of what the credit unions and the banks have to offer. The disparity in wealth between the minorities, and specifically the African American community and the rest of Polk County, is somewhat alarming, and it's still that way. The interest rate environment that we're in right now doesn't help that situation at all. But I think that with organizations, I see a couple organizations in here. Matter of fact, the Center for Success is here. They do a great job of reaching out to nonprofits as a community development financial institution. So we have a couple of those that are statewide, and we have some of the credit unions that are CDFIs also. But I think that we have to come to an understanding and better knowledge of how those two work together. And get on board, more outreach from the institutions and more education from the community.
Vince, if I could chime in for just a second, I'm curious. You mentioned the high unbanked rate among many of your clients, banked and the underbanked rates. Can you spend just a few minutes talking about what strategies or programs are in place to try to bring those numbers down and to bring those people into a banking family where they may have more opportunity?
Well, our goal is to try to give small dollar loans, just to give them, basically we utilize that to try to educate them, to let them know. The average interest rate, I think countrywide, is around 7.28. A lot of the individuals that we have may be closer to that 600 range. The reason being is because of cash, liquidity in their families. I mean, their household. To be financially well off, you should be paying your bills on time. You basically should have like 3 months of savings and so forth. A lot of these individuals don't. So anything that happens within their family, such as a furnace or a car breaking down and so forth, they have to go out and spend those resources, which dings their credit. So from that perspective, I think is what we're talking about. What we try to do is educate them. We give them the small dollar loans, but we try to make them understand what it is that you have to be aligned with, because in order to qualify at a regular lending institution, there are certain guidelines. Now, we think outside that box. We go outside that box because of the circumstances that most of these individuals have. They may have a credit score of 600, which most lending institutions wouldn't touch. But if you look at that individual's third-party credit, like rent, other expenses, utility bills, and so forth, if they don't have any lates or anything in those situations, it's not like that they're uncredit worthy. It's just that they don't have the resources. Back in 2014, the average family in Polk County made $57,000, where the average African American family made just under $27,000. So there's a $30,000 disparity right there. So you take a family with $27,000 and have a little bump in the road, it's going to affect their standing and their credit.
Okay, thank you.
If I could maybe just add
to
that, and thank you, Vince, for highlighting a couple of the things that we're working on together. This is a considerable focus for credit unions, is the unbanked and the underbanked. And one of the ways I think we combat it is we put a spotlight on it, we put time and focus on it. And Vince had mentioned this, but in Iowa, we have 70 credit unions, and 22 of them are designated as low income. 5 of them are community development financial institutions, or CDFIs. And there are only 9 of those in the state, and so we're very proud of that. It's a really challenging process to go through the Treasury to get approved for that, and it proves that you are doing the things that need to be done to try to reach out to underserved, unbanked communities and so forth. And one of the report that Vince mentioned, actually, I brought with me. I'm really proud of what our foundation does. But it's the business record featured it this last year, so thank you. But it's the economic realities of communities of color in Iowa. And yes, while Iowa is doing well as a whole, as Vince mentioned, that's not necessarily the same for everybody. And a couple of really sobering statistics beyond what Vince had mentioned. And we talk about home ownership, and that's a huge part of what we do. And that's a big part of wealth building, obviously, and for anyone. 73% of white Iowans are homeowners. Compare that to Hispanic Iowans, and it's 53%. Black and African American Iowans, 23%. I mean, it's sobering, the difference there. And so one of the things that we're doing from a home ownership perspective specifically, and our two largest credit unions in the state have led this, one is Green State and Veridian, but several others have signed on, is that they made a commitment that over 10 years they'll take 10% of their assets and put them towards more affordable home loans and mortgages for people of color. And they're tracking very well on that. So for our largest institution, that's about $1 billion of affordable home loans over a 10-year span, and we're tracking ahead of that. And so part of it is just putting a spotlight on it, and part of it's just getting to work, and it doesn't. Nobody can do it alone. So the community partnerships, economic development groups, we all need to get together to make sure that those things happen.
All right, thank you.
Thank you, Michael. And I just wanted to circle back on something that Murray said, but go to Don, talking about liquidity. Murray had mentioned that it had been an issue for banks and credit unions for the last 18 months, making lending and securing capital for commercial office projects, non-housing projects, challenging. How is current monetary policy affecting lending for commercial projects in Iowa? I know you mentioned earlier that the important projects are getting done, but just could you take a little bit deeper dive as a whole? How is that impacting projects in Iowa, and how could that possibly change this year?
Yeah, I would say a couple things just on liquidity, and I'm only going to talk to Bankers Trust liquidity. So we've grown $600 million in deposits since March 30th to the end of the year, so which is roughly 15% of our total deposits. So we have grown deposits. We have liquidity, probably more than we've had in my tenure there, but it comes with a cost, and that cost is in the interest rate side. So our costs are up considerably. That makes pricing loans kind of difficult, because when the yield curve is inverted like it is, so we borrow and issue CDs and other accounts on the short end of the yield curve, so that's a little higher, and then we're lending money usually sometimes on a 3 or 5 year, and that's priced off a treasury usually. So to get a spread there is very difficult, which means rates are higher for borrowers. How does that affect development projects? I think if we just talk development pieces, again, I think good projects are getting done. They might have to add capital or whatever. I just don't think the rates change so fast and costs increase so fast that nothing is caught up, and we haven't achieved that, we'll call it equilibrium in the market, to where cap rates equal what it should, and projects get done at a certain price. So it's all a math equation, as Jenny in the room would say, in the back probably. I don't see her, but, oh, there she is. It is a math equation in terms of what amount of capital goes in a deal, what kind of loan to value is it, what are the rents, what is the rate. So this too shall pass, in my opinion. The good projects get done, and they're not doing a development deal because the rate is higher necessarily. It's just a combination of all the things, the costs and what they can achieve on a internal rate of return on that particular project.
Thank you. John, I wanted to kind of expand on that a little bit with you, but then into affordable housing. I know that the affordable housing has been identified as a central issue for Central Iowa's Capital Crossroads initiative, and it's an issue nationwide. Now, the capital stack can be a lot more complicated with affordable housing because you have tax credits, you have incentives and stuff from government agencies. But housing experts are wanting to see more owner-occupied housing And in Des Moines, just as of December, the average home sale price was about $203,000, which is up 14% year over year, and that's according to Redfin. Just wanted to ask you, how are inflation and high interest rates, they've caused construction costs to go up, but how is that policy going to affect affordable housing prices in 2024? And what does lending look like today for the single family and multifamily housing developments? I know it's kind of a lot to unpack there, but.
Can you give me an easier one, Mike? Well, one thing in response to some of the comments made, the number of activities bankers are engaged in are more than I can enumerate up here. We're the #1 small business administration lender in the state of Iowa. We're the #1 first-time home buyer producers for Iowans. We actually operate a mortgage company at the Iowa Bankers Association. Banks can't hold 30-year mortgages on their books. We buy those mortgages from banks, package them, sell them to investors as a way to add liquidity back to Iowans. There are Iowans struggling not just in metropolitan areas, but in rural areas, which takes a lot of our time. And we have many banks, and I could give you examples, who deliver 10% of their profits back into their community. So it's hard for me to stand up here and talk about individual, because I have 275 members. But I can tell you a lot of the activities of reaching out and connecting with your customers, because we're relationship lenders. We don't sell products. We develop relationships with our customers, and that's all based on trust. So anyway, I wanted to get my commercial in, because there have been a few commercials up here that I think need to be balanced. I guess the other thing on, the housing market, right? That's a difficult one. With the increase in interest rates, the housing affordability increase, our index has become as bad as it's been in a long time. Believe me, I have 2 kids living in Des Moines and a new 16-month-old granddaughter. And my daughter and son-in-law would love to move up to a new house, but they have a really difficult time giving up that 3% mortgage. And so what that means, they're in a nice starter house. You don't have the churning, right? So we don't have opportunities for people to move up into homes. And I think until rates moderate a bit more, we're now at about 6.6, I think was the Fannie Mae average as of yesterday. Until that moderates, probably down below 6, I don't think we're going to see a lot of movement there. So I guess, Mike, to get to your question, I probably won't address everything you included in that, but there are things we can do to help in affordable housing. Habitat for Humanity has been a wonderful partner of ours in the community, and they're doing great things, but obviously it takes more than that. There are some bills in the legislature. One bill would increase the workforce housing tax credit, which is where we've put millions of dollars to encourage developers not only to build new, but also to go into communities and renovate existing homes. We have a very old housing stock in our state. And after the Great Recession, there was not a lot of resources put into new homes or keeping up new homes, both multifamily and single family. So from a supply and demand standpoint, we still need to catch up to the demand that we have on the housing side. So we've got this unique environment, Mike, where prices have continued to increase or remain the same at the same time that the interest rate costs have pushed up mortgages, right? So there's no easy answer. There's no easy answer to this, but I think eventually, as rates come down, we can start to make some real progress on housing affordability, and until then, we're just going to have to be creative in coming up with additional ways. Another bill that's being talked about at the Capitol is to make sure that some of the building code requirements don't increase the cost of housing so much that people just cannot afford to buy them. So there are things we can do to nibble around the edges until we can get a better interest rate environment.
John, I gave you that one because I knew you could do it. So, I actually do want to stick with you for a second. So, you were talking a little bit about the politics and regulation that's out there right now in banking. Last year we saw some regional bank failures, including the Silicon Valley Bank. Talk a little bit about how that impacts regulation, or how that has impacted talk of regulation in the environment, and then where does the risk stand today for banks and credit unions in Iowa and nationwide?
Yeah, Mike, good question. I mean, obviously, back in March of last year, we had what they termed the regional bank crisis. Frankly, it amounted to about 3 banks, Silicon Valley Bank being the most significant one. Very unique business model. We think it's idiosyncratic, right? I mean, they basically served tech companies that relied on venture funds for a lot of their capital. And when interest rates went up 500 basis points, that made that capital more difficult to get. In addition, those financial institutions were not focusing on interest rate risk. And so when that change occurred, and on top of that, most of their deposits were not federally insured. They were not FDIC insured deposits. About 94% of their deposits were uninsured. So depositors ran, not only were they sophisticated from a technology standpoint, because they could move it on their phone, so the money ran quickly, and it caught regulators off guard. So that's really what transpired there. That obviously shook up the marketplace. When you had that kind of increase in interest rates, we also saw people look at their deposit accounts and think about, okay, am I with a healthy institution? Am I getting the best return on my deposits? So a lot of our members spend a good deal of time reaching out to their business and consumer customers and assuring them that the bank is healthy and strong. And I can tell you, in Iowa, our banks are very well capitalized. They have adequate liquidity today. Our credit quality is exceptional, so there's not a lot of loan charge-offs or delinquencies. So we're in a good spot to continue to serve the Iowa economy, despite some of the discussions that occurred last March, and really continue today with New York Community Bank, which is also, we think, a very unique circumstance.
Don, similar question to you. Where are you seeing the greatest risk today for banks and credit unions in the state of Iowa?
Well, so far the credit quality has been very, very stable, not only at our bank, but I think most every bank in Iowa. And it just feels like, from a risk perspective, it's all about concentrations. What we're talking about with Silicon Valley was a concentration of assets. We're talking about, for risk, it's concentrations of whatever it is that you're concentrated in. What are the risks of that particular piece? And every bank has a little bit different levels of concentration. We focus a lot on it at Bankers Trust, and maybe all the banks do. But are you focused in office buildings, and are you focused in multifamily? What are your concentrations in all of these various different types of real estate? What is your concentrations in the commercial, industrial world? Are you all in one industry? Are you not? Are you more heavily weighted in geography? So there's all kinds of concentrations, and that's really what yields the problems, is when you have a bulk of your assets tied up in one of those areas, and something happens to that particular industry that causes a downside. So I think it's managing your concentration.
Great. Murray, I know that, of course, credit unions, they're member-owned. There's some differences. What specifically is the credit union industry looking at as far as risk this year? Are there differences from what you're looking at, from what the banks are looking at?
I think it's similar in a lot of ways, but when I think about what we're hearing from our credit unions, I would call these probably more challenges than risks. Workforce continues to be a significant challenge. We are, just like banks, we are retail operations, and so we are competing for talent with all other retailers out there, and the cost of talent continues to go up. And so workforce challenges continue to be a hot button for our credit unions. I'll go back to what John said. I think regulatory burden is a big challenge. And I'll caveat this to say that our state regulator, Katie Averill, is here. So I'm not talking about state regulations. That's wonderful. But in all seriousness, there, especially at the federal level, there is almost a hyper-regulatory environment going on right now. And for banks and community credit unions, there is this trickle-down effect of kind of one-size-fits-all regulation that just gets really challenging for community financial institutions. The intention may be for the very, very largest, but what happens is the impact, it hits on Main Street and it hits in our community financial institutions, and the cost and the infrastructure that is needed for that, which was never really intended for our size institutions in the first place, becomes crushing. And so I would say the biggest challenges are things on workforce, just operational costs, and also the regulatory burden.
Okay. Vince, when you're advising your clients and trying to help them gain access to capital, what are you paying attention to when it comes to risk with banks and credit unions, and how are you advising your clients to pay attention to that?
Well, my advice is to go where you can get the best deal. And it depends on what you need. Like I said, a lot of ours are startup businesses. We've got some small businesses that been in business for 5 years and could use a lot more capital. So just like I would think that all of us as consumers, that you've got to shop around and see who has the best deal out there. Now, one of the advantages is that the larger banks with the CRA regulations and so forth bring more resources back into the community. So from our perspective, that's who we first approach also ourselves. But as Murray and I were talking earlier, though, we utilize the credit unions also quite a bit. I look at it as a community. And who we're working with is trying to raise potential business for both banks and for credit unions, because as those small businesses grow, so do their deposits. And as those deposits grow, so do these institutions. So it's a give and take type relationship. So that's how I look at it.
All right. I'm going to go back to John for this one. So, high yield savings accounts, investment accounts have been one tool that banks have used in recent years. You've seen a lot of that ramping up for credit unions and banks to keep depositors, to keep that liquid capital on the books. Can you talk about how that might have impacted commercial lending, and what other types of products and services do you think we'll see in 2024 to make sure so banks and credit unions can keep those depositors?
Yeah, there are a lot of tools, Mike. I think you're right when you say high yield accounts. I assume you mean sweep accounts into investment products.
Yeah.
When you have a 2-year, 10-year paying 5 or 5.5%, and you're dealing with an inverted yield curve, that presents challenges, right, for banks to compete. Having said that, you look at a lot of CDs today, and you can get 5 or 5.5% in a CD. So I mean, banks have adjusted to that marketplace, and we have a lot of tools today that maybe weren't quite as visible. Obviously, when the whole Signature Bank and SVB Bank happened, the Fed came out with a new term funding program that banks could tap into to utilize their bond portfolio to gain additional liquidity. So that's one way, and that actually expires in March. But we're back to a more normal environment today. The Des Moines Federal Home Loan Bank, who you all know here, is a very important partner for our financial institutions. Their primary role when they were created is to be a source of liquidity for smaller financial institutions so they could access the capital markets and get those at a more reasonable rate. They also have an affordable housing part of what they do and a community development part of what they do, and the banks play a key role there in delivering those products and services. So another key source of liquidity. The other thing banks can do today, because people are still concerned about having their dollars insured, federally insured, we have the ability to take a large depositor and spread those deposits over multiple financial institutions, $250,000 each, and get coverage for maybe a depositor who has, a business depositor that has millions that they need to get covered. So that's called a reciprocal deposit program. So there are a lot more tools today to provide those kinds of services that customers are looking for and get them a better return.
Okay, thank you. Don, similar question to you. What tools are, I mean, it could be Bankers Trust, but what tools are you seeing just in the market itself to keep depositors, and how are those higher like interest accounts and stuff impacting commercial lending?
Well, the tools are pretty similar to what John just mentioned. The insured credit sweep has been a big part of that, just to get your insured depositors, get them more comfortable, I think. But in terms of the impact on lending, I think it's impacted only by the specific interest rate that needs to be charged to get it done. So our margin, and it's not, I don't think it's a secret, but we had a margin of maybe 306 going into the year, and we're maybe 240 now. So 60 basis points on $5 billion is still a lot. So, are we able to charge enough to make the deal or not? And how do we fit into the stack of capital that needs to be done to get a deal done? So how we price is really the biggest issue. And we need to make a return, and so does everybody out there that's doing the deal.
Okay, all right. And Murray, to you. Yeah.
Yeah, early in my career, I was taught a lesson that the best investment a credit union can make is a loan to its members. And so to make loans, you need deposits. And we are seeing historically low deposit growth rates in credit unions right now. And so it's a challenging environment, like everyone has already said from that perspective. And so just like what the banks are doing, the credit unions are doing the same things. But I would say that the ability to lend is core to what we do. And so what's going to happen is credit unions will take a hit to its earnings, and it will continue to lend. But the battle for deposits, the ability to retain deposits is very challenging right now.
Do you expect that to change this year? Or do you anticipate that deposit rates will start to go up in 2024? And if so, why? Oh, that's to Murray. Yeah, this one.
If I had a crystal ball, I would let you know. I don't know.
Okay.
No.
I don't know the answer to that question, but one other thing I'd like to add is at Bankers Trust, it's felt really good to be privately held. In the middle of last year, when a lot of banks had their pencils down and not lending and not doing anything, we were able to keep going and doing the right thing. And that's been a huge plus. We're not focused on 90 days at a time for an earnings call. We're focused on getting the job done for our communities, so moving forward.
Great. Michael, do you think we should maybe take some
Well, no, I'm
follow-up?
curious. I want to follow up a little bit on this issue of deposits. John, statewide, with your members, what does that look like overall? I know what Don said, the Bankers Trust deposits were looking like. We just heard Murray say that deposits at credit unions were low.
Yeah.
Just overall within your membership, what are you seeing?
So yeah, I think that's right. I mean, we're struggling. I mean, obviously we had more liquidity than we needed post-pandemic. It's now flipped completely. I guess I haven't looked for a while at the statewide loan-to-deposit ratio, but we are having, what we're seeing is banks going out and getting more Federal Home Loan Bank funding or brokered deposits or other wholesale opportunities that they have to build those funds, which is fine, but those tend to be more costly deposits, which can impact your cost of credit, right, back to the community. So I don't know if that answers your question, but that's...
So what do you think needs to happen with the economy within the marketplace to really start to turn that trend so that you see a higher rate of deposits?
I just think we need to get further away from the Fed extraordinary action to address inflation. As we move further away from that and the Fed now starts to moderate and possibly reduce interest rates, it will take care of itself.
Anybody else on the panel like to address that? Don, do you want to revisit or follow up on anything that John just said?
Yeah, no, I agree with that. I think the the Fed retreating would certainly help that. I don't hold out a lot of hope that that's anytime soon, just because I think there's going to be a fear of manipulating with the election or whatever. I think they'll drop one time this year, and that's about it. So I think we're in for higher for longer has been the call, and I think that's accurate.
I'd ask a question about how I can more accurately reconcile my checkbook. That sounds probably more like a me issue than an issue these people want to hear about today.
Probably asking the wrong people.
Yeah.
I'll take some help too.
Vince, do you want to add anything on this conversation before we turn the page and move on about deposits and liquidity?
No, I think I'd probably be overstepping my boundaries there. These gentlemen deal with it on a day-to-day basis. I'm no longer connected with that, my past history. I would have, but I think they've done an exceptional job highlighting all the issues.
Mike?
Yeah, Don, I'm just curious, when you're in kind of this uncertain market, you have interest rates that are expected to drop, but there's not certainty as to when they're going to drop this year. How do you plan for that as part of your balance sheet as the bank, and how do you plan for that when you're doing your growth models and estimating? Like what's the strategy there?
Well, we try to remain sort of agnostic in terms of interest rates, and I asked our CFO the other day, what am I rooting for? Because I really don't know. I really don't know if going down helps us or going up helps us. It really depends on the shape of the yield curve, because we've structured our balance sheet. Half of our loans roughly are fixed rate, half of our loans are variable, and that's been like that. And the reason we do that, you sacrifice a little in both high rates and low rate times, but you end up at making money in every interest rate environment. And that's really what we try to focus on.
Yeah. And John, is it how difficult is it to plan in this market? For banks and credit unions. Just talk about the difficulties that you've experienced trying to navigate the environment, or your clients have.
Well, Don actually has to run a bank. I don't. Yeah. So it's a little easier for me. I can pontificate all I want. But yeah, obviously, asset liability management, right? That's Rule 101 for most financial institutions, and it has become difficult. I think a lot of our banks said, what I'm going to do in this environment when there's so much uncertainty, I'm going to focus on the customers I have, and I'm going to give them the best possible service, the best possible rates, and not chase other new customers or other opportunities. And so I really think that's kind of been the MO for most of our banks through much of last year and probably the first part of this year until we have a better idea of the direction we're headed. But as Don mentioned, we've got a pretty solid economy here. You look at the labor numbers. CPI came in back a little higher than anticipated, which scared the market a little bit. But we're still rolling along at a pretty good clip as an economy. And I hope we can get to the point where the markets don't base all of their action on what the Fed does and actually look at the fundamentals of how our companies are doing. Because many of you are doing very well, and you've had your own challenges in this environment, and that's my members here to help you through that.
So I'm curious. You mentioned the inflation rate dropping, not as far as some economists had hoped and predicted. 3.1% is, I think, where it was on Monday. There were some people hoping it would drop down as low as 2.9. What is the practical effect of that on how you guys do business and how everyone out here does business on a daily and weekly, monthly, annual basis?
Hopefully none. I mean, that was a 0.2% difference in what was expected to what actually came in. So as we mentioned at the outset, the Fed is data dependent. I was in San Antonio over the last couple of days at a community bankers conference, and Mickey Bowman, who's one of the Fed governors, was there, and somebody was interviewing her in a fireside conversation, and they were going through all the reasons that the Fed should cut rates in May, and she said, well, let's see, are we at that 2% core inflation rate that we want to be at? And the answer is no, we aren't. So I think until they drop at least into the 2% range for core inflation, we probably aren't going to see a lot of rate movement. As far as, I don't know, Don, you'd have a better idea what you do to react to that, but.
I don't know that we do anything different at 3.1 versus 2.9 or 2.5 or, I know when the inflation rate's at 6, I know what the employees expect for a raise, but.
Well, that is interesting because if you look at, go back 3 years and look at inflation versus wage increases are still less than inflation. So from a real wage growth standpoint, we're not there yet. We aren't back to where we should be.
Murray, do you want to add anything to the conversation? Oh,
No, I think that's well said.
okay. Pass it on to you, Mike.
Yeah, we still have some time left, and one of the things we talked about is possibly throwing it to the audience. You guys, everybody that's sitting out here has skin in the game, involved in the profession. So we just wanted to ask if anybody has questions for our panelists, if anybody would like to add anything, or just something that's burning that they'd like to get out there. Don't be shy. No?
Questions, comments?
Too many bankers in the room, I think.
That's okay. You guys mentioned employees, and so if you maybe talk, let's talk a little bit about bank and credit union employees and the impact that the environment, this environment has on them. And so talk about how when you have an uncertain market, have uncertain times. Don, what kind of how do you manage through that with your employees at Bankers Trust and just in general?
That's a great question. There's a whole list of things that we try to do to make people comfortable and make people feel valued and make people feel like they're part of the organization, and whatever they're doing in their job adds to our strategic plan and adds to the bottom line of the bank, and as well as the bottom line that is the community part of it. So whether that's volunteerism, whether that's us giving back, there's a whole bunch of things that mixed in. But one thing I found out today is that we have a relaxation room in our bank, and I didn't know we had it. So evidently people can go in there and rest in a massage chair for 20 minutes, or maybe I don't know what they're doing in there, but I'm going to find out. So,
is that open to customers too?
I got to check it out. I don't know. So,
all right, and maybe to anybody else on the panel, Vince, Murray, John, you want to add to that?
We do Friday afternoon cocktail hours.
All right.
So if you want to work for the Iowa Bankers Association, you can meet me afterwards.
Right.
No, along with the package of benefits and creating an environment where people want to work. I have 2 of my employees here, so I have to be very careful about what I say. Some of those unique opportunities to build the team, make them feel like we care about them and that we do care about them. And that you're presenting opportunities for them to network with other employees is appropriate. So this is why I don't get in front of them all that often.
If we're not careful, John's going to organize a happy hour here. So, one thing we touched on briefly in the intro, and I believe it was Murray, I apologize if I'm wrong, but it was AI in banking, and it wouldn't be a business record power breakfast without at least talking about AI a little bit. So I kind of want to go down the line and talk a little bit about how you all see AI impacting banking and lending in 2024, and just some of the and how quickly is that adoption happening in your industry, and what are some of the more significant changes you expect? So Don, we'll start with you, and we'll just go on down.
So AI, other than me playing with ChatGPT once in a while, I probably don't know that much about it, but we certainly are using and utilizing artificial intelligence in the bank actually today with a lot of different products. The one I'm thinking of is integrated payables and receivables. It uses bots to kind of match up various different things and be smart about making the CFO's job a lot easier with our customers. I know there's a bunch of other stuff that I'm missing, but that's the one I'm thinking of.
Vince, how are you seeing AI utilized in the nonprofit realm?
Well, to be honest with you, right now, I don't see it affecting us too much. We're mainly face-to-face with most of our customers. But I do think going forward, and some of the things that I've read, it's definitely going to involve everybody in this room. I don't think that we can get away from it. So I try to at least stay on top of it.
John, what about you?
Yeah, Mike, so our one application that we're using, we actually service loans on behalf of the investors that we sell to. So we service about 67,000 loans in 10 states at the Iowa Bankers Mortgage Company. And we are using, I guess it would be more machine learning, not generative AI, but we're using that to speed up the processes of servicing those loans. So it's amazing where it's showing up. I think in the banking industry, it's going to make a huge difference on all. We have a lot of procedures, a lot of deal with a lot of documentation. Obviously, much of that is no longer manual, but just to be able to go through that decision tree and make those decisions more quickly, especially in the area of regulatory compliance, could be a real game changer. Having said that, I do think we need a regulatory scheme in place to make that more consistent for just generally for business.
Murray?
Yeah, we this was a big topic of conversation here recently. We have a board planning, visioning process that we do every couple of years, and we just did it last fall, and it was happening right when all the ChatGPT hoopla was coming out, and so it was a big part of that discussion. And what we're hearing and what we're using in our own organization is really what everyone else has said, is really more back-end efficiency, things to help us be more productive and do higher level work with the employees that we have. We are in the world of relationships, right? Community banks, credit unions, this is what we do. So I think everyone was confident that AI needs to be used. It is being utilized, but it's going to start from the back end working towards the front, because the relationships that we have with our members, with bank customers, is paramount. And to put AI in between that, even if it's able, is kind of a dangerous and slippery slope. But what I'd said earlier, there's also the challenges of data privacy, data security that go along with this that are, the technology moves much faster than our ability to understand sometimes what the implications will be. And so that's kind of where we're looking, is you have to dip your toe in the water. You have to be a part of this. It's just another tool. It's another way to do your business, but, tread softly.
Do you have a follow-up, Mike?
No, I'm good.
John, you mentioned regulation in AI, specifically in banking. This is to the whole panel. Anybody who wants to jump in, specifically in banking, how do you anticipate regulations will unfold in AI and banking, and what do you see as appropriate, and what do you see versus what you see coming down the pipeline?
So remember, this is a Congress that only passed 20 bills last year. So I'm not optimistic that we're going to get a comprehensive AI regulation bill. And obviously it would have to encompass not just banking, but business in general. And it's not easy to do. Our regulators are certainly looking at it now and making sure that it's used in an appropriate way. Like I say, a lot of them, as Murray referenced, a lot of them are backroom. They're not customer facing at this point in time. So I think most of our industry is being careful about how we're using it. Having said that, it is an exciting technology. I mean, there are things that can be done to really improve even service to underserved communities. And so there are many possibilities. That I think we need to continue to learn about and understand and look for ways we can implement.
I think the regulations will mirror whatever we can control. So if we can control the risk, if we can control the data, if we control personal information, if we can control that and make sure that we know what the AI is seeking out and what it's making decisions on, then the regulation part becomes a lot easier. And so I don't think they can impose regulation without knowing what the control piece is. So it'll be a mixed bag, and it'll come together, I think.
Heidi?
think the question was, is there concern about private credit? And what was the second part of your question? And then it's not very regulated, so.
Yeah, exactly, Heidi. I mean, you know that better than I do. A lot of our financial activities, because of the significant regulatory scheme that we work under, are moving outside of the banking system. Private credit certainly don't have the same level of regulation that we do. I mean, banks have examiners in their banks on a regular basis, reviewing everything from consumer compliance to safety and soundness to fair lending, the whole scope of thing. I think we saw a lot of the mortgage activity move out of the regulated banking industry post Great Recession, financial crisis. And so, I think it's something we need to pay attention to. We've always advocated, similar activities, similar regulation. Easier said than done, but that's always been our mantra.
Yeah, I would echo that. It's very, very similar between credit unions and banks in terms of the level of high oversight from a regulatory standpoint. So when you have other entrants in the marketplace, it sounds great, right? It sounds great until it's not. And that's when you start to find challenges. And so not all regulation is bad. It's good to make sure that there is that level playing field in terms of making sure you're protecting consumers and their own well-being in this as well. And so sometimes things seem wonderful, they seem too good to be true, and they are until something bad happens. And that's where credit unions and banks, I think, because of that regulatory environment, because of the insured deposits, all the things that we have in place, it can be a dangerous place out there outside of those regulated entities.
All right. Any other questions from the audience before we start to wrap up? Anybody else? Okay, thank you for that very much. We are actually getting pretty close to our time. It's been a robust, in-depth discussion. So I just want to thank all of our panelists. We do have time for one additional question, and I think that there's been a lot of talk about uncertainty, but I'd like to leave here on a high note with something positive. So I'm going to ask to all of our panelists, what is something that you predict will go right in Iowa's lending and banking sectors in 2024? Also, just any final takeaways that you have. So, but before you answer, I'm going to like to give you all just a few moments to collect your thoughts, and before you share the final takeaways, and I'm going to send it back to Michael to let our audience know about a couple of things and events we have coming up at the Business Record.
All right, thanks, Mike. And as most of you know, we have a whole calendar full of events coming up over the course of the year. The next few that I want to bring to your attention, and I want you to mark your calendars for, is our 40 Under 40 celebration coming up on March 28th at Prairie Meadows. But we want you to tune in next week at 12:15 p.m. on Wednesday, February 21st, as we announce this year's honorees live on the Business Record Facebook page. And again, that will be February 21st, this upcoming Wednesday, 12:15 p.m. We also have our next DSM Magazine event. They will be hosting the second annual Home Design Awards on Tuesday, February 27th at Willow on Grand. And on April 25th, join us for our Commercial Real Estate Forum at our new location at the Downtown Hilton Hotel. So, Michael, I'll kick it back to you.
All right. Well, back to that final question, and again, it was something positive that you predict that's going to go right in Iowa's lending market and banking sectors in 2024, and just any final thoughts or takeaways. So we'll start with Dawn and head down the table.
What's going to go right in banking? I think in Iowa that our businesses are going to have a strong year. I don't think it'll be as a result of or because of interest rates, but I think in spite of, maybe. And so I'm very positive about the outlook for business in Iowa. In terms of, I think you said a final takeaway is, I do think we're going to have rates higher for longer, but I don't necessarily think that's a bad thing. It's not great for our income, but I think I think equilibrium will kind of adjust in the market in terms of prices and cap rates and the things I mentioned earlier. and deals will get done, and we will move forward.
Thank you. Vince?
I think that the positive things that will happen in Iowa, from my perspective, is that we'll build better relationships with the lending institutions from the nonprofit world and reaching those unbanked and underserved communities throughout the state. There's 4 other affiliates across the state, so we communicate. So hopefully we can build that relationship, and we'll get the resources that we need to move that needle on the number of new small businesses throughout our communities.
Great, thanks. John?
Yeah, I would say positive. I think we're headed for a soft landing. I think interest rates will tend to trail downward towards the second half of the year. I think our business community is going to remain strong. And Murray and Williams and I have decided we're going to merge our 2 organizations after this discussion, and we'll kumbaya on the financial industry. So
John, we did tell you that everything you say here is on the record, right?
record, well, it hasn't been signed yet, so.
Dogs and cats living together. Beyond that news, I don't think it's hard to be optimistic here in Iowa, where we're at right now and where we're heading. We have our annual credit union convention in the fall, and we were a little wondering how everyone's attitudes would be, and there was a high degree of energy and optimism even a few months back about where we're heading. I mean, Iowans are resilient. I think there was an attitude of being able to weather the storm and coming out the other end, and we are not done yet. Obviously, we've all heard that, but there's a great degree of optimism, I think, about where we as financials are heading, but also where the state is heading. And so I think the overall outlook is good and very positive.
Great, thank you. I just want to thank all of our panelists. Again, can we just give them one more round of applause? Thank you so much for everything today, your insights.
Thanks, John.
And on a personal note, this was also my first in-person moderating of a Power Breakfast panel for Business Records. So thank you all for bearing with me as I worked through it. Thank you, Michael. We appreciate everyone choosing to spend your morning with us today. We hope it was helpful. Hope it provided you some insights for your business. Thanks again to all of our sponsors for helping make today possible. And again, our speakers. So everybody have a good rest of your day.